A very good afternoon to all the viewers of today's VCM, role of securitization and covered bonds in deepening fixed income market in India. The topic is very technical in nature, and I hope that through this webinar, this VCM, the viewers will be having a new insight about this very important topic. And this securitization and covered bond market is growing like anything. And today we have branch office bearer of Ajmer branch of CIC of ICAI, my own chairman, C. Anuj ji with us. C. Anuj Goyal, chairman of Capital Market Committee is with us. We have learned speaker Anikia Kulkarni ji and Anshul Gupta ji. And with these two of the speakers and visionary chairman who would be delivering us the opening remark, he will be give us insight. And with these learned speakers and torchbearers of the profession, we would be receiving new knowledge and new insight on this very important topic of today's VCM. So not taking much time, I would request CA Avnish Garg ji, chairman of Ajmer branch of CIC of ICAI, for his welcome address. Over to Avnish.
Thank you, अमित जी. मैं सभी मेंबर्स का इस VCM में स्वागत करता हूं. आज की VCM का टॉपिक जो है रोल ऑफ सिक्योरिटाइजेशन एंड कवर्ड बॉन्ड्स एंड डीपनिंग फिक्स्ड इनकम मार्केट ऑफ इंडिया. एक बहुत अच्छा और टेक्निकल टॉपिक है और मैं जो है अनुज गोयल सर का जो सेंट्रल काउंसिल मेंबर और चेयरमैन ऑफ दिस कमिटी है उनका बहुत बहुत शुक्रगुजार हूं कि उन्होंने अजमेर ब्रांच को ये अवसर दिया कि अजमेर ब्रांच अनुज सर के सानिध्य में ये एक जो है VCM कर सके और जो मेंबर्स की रूटीन की जो प्रैक्टिस है, रूटीन के जो टॉपिक हैं उससे हटके एक अलग जो सिक्योरिटाइजेशन एंड बॉन्ड है जो काफ़ी कम लोगों का जिसमें जागरूकता होगी उसका एक टॉपिक इन्होंने दिया. सर का मैं बहुत बहुत स्वागत करता हूं अनुज गोयल सर का अजमेर ब्रांच की तरफ से. मैं स्वागत करूंगा जय छेड़ा जी का, वाइस चेयरमैन ऑफ दिस कमिटी and Central Council member in absentia. आज के स्पीकर हमारे अजिंक्य कुलकर्णी जी, को-फाउंडर ऑफ विंट वेल्थ एंड अंशुल गुप्ता जी, को-फाउंडर विंट वेल्थ. आप सभी का अजमेर ब्रांच की तरफ से, इस कमेटी की तरफ से बहुत बहुत स्वागत है.
Thank you, Chairman sir.
Thank you, and we are having the presence of CACP Jain ji, our honorable past chairman of Ajmer branch. May I request CACP Jain ji for a few words on this occasion. CACP Jain ji. Over to Amit ji.
Yeah, thank you, Chairman sir. And now I request CA Arhint Kumar Jain, Vice Chairman of Ajmer branch of CIC of ICAI, for introducing our today's one of the speaker, Ajinkya Kulkarni ji. Over to Arhant Jain sir.
Thank you, Amit sir. The Ajinkya Kulkarni comes with a rich experience of working in lending and financial services for more than 6 years. Prior to Wind Wealth, Ajinkya was Vice President and Head of the Merchant Lending business at MSIP. Through MSIP Merchant Lending, he enabled credit access of thousands of merchants. In a short span of 6 months from launching, he built a profitable portfolio of more than 25 crores. On academic forefront, he pursued mechanical engineering from IIT Gandhinagar.
Thank you, Vice Chairman sir, from his enriched experience and this engineering background. Let me share with you that I was Secretary of Committee for Members and Industry. I used to deliberate on this issue where our chartered accountant should be placed. We should learn from Ajinkya ji that he is from engineering background and he's contributing like anything, and it's a great contribution in finance field. So we should be open for all the field. Now, taking the opportunity to introduce Anshul Gupta ji, I request Surendra Somani sir, CA Surendra Somani sir, Treasurer and past Chairman of Ajmer branch of CIC of ICAI, for introducing Anshul Gupta. Over to Surendra sir.
थैंक यू सर, अमित सर, थैंक यू सर. आज सबसे पहले को गुड आफ्टरनून टू ऑल ऑफ यू. एंड आज हमारे अजमेर का सौभाग्य है कि हमारे इतनी बड़ी इस टॉपिक पे VCM हो रही है. ये हमारे बड़े भाई साहब अनुज जी गोयल की तरफ से है, उनका ही वो है सानिध्य के हमारे साथ ये जुड़े हुए हैं. आज मैं अजमेर ब्रांच से अंशुल गुप्ता जी का भी हार्दिक स्वागत करता हूँ. अब मैं अंशुल गुप्ता जी का इंट्रोडक्शन बताऊं. अंशुल गुप्ता co-founder of Winkwell, and earlier he has worked as Director Strategic Alliance and Head of Product with the Northern Art Capitals for more than 5 years. And his experience includes launching of new business and vertical of the organization and forming long-term strategic alliances with counterparties. Further, he has conceptual and launched various innovative processes, many which is India's first of the its kind. He is IIT Roorkee, and he has CFA और FRA लेवल भी पास क्लियर कर चुके. आज इनसे हम अजमेर ब्रांच के लिए नए बिजनेस के बारे में नए जानने और सीखने का मौका मिलेगा. इनसे इस नए टॉपिक पे बहुत अच्छा हमें मिलेगा. तो मेरी एक रिक्वेस्ट है सभी जुड़े हुए पार्टिसिपेंट से कि पूरा प्रोग्राम ढंग से अटेंड करें, तो अपने को नई बिजनेस के बारे में इनसे बहुत अच्छा ज्ञान मिलेगा. थैंक यू सर.
Thank you, Somani sir, for your brief intro about Anshul Gupta ji. Now I request CA Rahul Jain ji, Sikasa Chairman of Ajmer branch of CIC of ICAI, to introduce our worthy visionary Chairman, C. Anuj Goel. Over to Rahul.
Thank you, sir. You give me such an immense pleasure to introduce Sir Anuj Goel to everyone. He is a Central Council member of Institute. He also contribute immensely in various capacity as 14 year in council, 3 year in regional council, 6 year in branch, and he presently was the chairman of the research committee, the oldest committee of Institute, and also the capital market and investors protection committee of ICAI. He also is the vice chairman of the corporate law and corporate governance committee, and with his exemplary academics, he possesses like this. He is the CA, CS, CMA, ICAW, LLB, MCOM, and DISA and DIRM. It is a immense pleasure, sir. Thank you, sir.
Thank you very much. Thank you, Rahul.
Yeah, thank you, Rahul ji, for giving a brief intro of our chairman, C. Anuj Goel ji, the visionary chairman of the market committee. It's a very formal intro of C. Anuj Goel ji given by your good self. Is about his academic qualification and all these things. Let me share with you my experience as C. Anuj Goel ji as a chairman in various committees. I served with him in not less than 5 committees of central committees of ICAI. He is a very visionary, dynamic personality. With his vast 15 years of experience in the council, he has contributed like anything. Let me share with you that in his very first meeting of this capital market committee, he take up one agenda item on derivatives, and now the CAs are allowed to do derivative business. Derivative can trade in derivative for their own. So this is one thing that I'm sharing with you. Apart from that, he has vast experience and wide. He's contributing like anything. Every day we have a phone call of around 3 hours to 4 hours just to discuss in this Corona period, just to discuss what is to be improved in the system for capital market. He is the chairman of research committee also, and I am the secretary of that committee. So we used to discuss 3 hours, 4 hours in a day, how to improve the course curriculum of various certificate courses, how to bring new. In this Corona period, he is very much concerned about how to bring out our members from this negativity and how to occupy them in this some knowledge gaining series and giving them connecting them with the good speakers, because which is otherwise in physical mode it is not possible to travel big speakers, but through these webinars we are connecting international speakers also, although time is a constraint for us, so I'm not taking much time. And I request C. Anuj Goyalji, Chairman of Capital Market Committee and Investors Production Committee, for his opening remark and guiding words.
Yeah, thank you, Dr. Amit Agrawalji, our young and dynamic Secretary of Committee on Capital Markets and Investors Protection. I welcome our honorable guest speakers, CA Ansul Gupta ji and CA and Sri Ajike Kulkarni ji. Both are IITians on behalf of the Institute of Chartered Accountants of India and on behalf of the Ajmer branch. Ajmer branch is very well known for the only temple of Bhagwan Brahma, and we are really fortunate that Ajmer branch is hosting this virtual CP meeting, which is attended by around 3,000 delegates from each and every part of the world. And I welcome the chairman of the Ajmer branch, CA Avnish Garg ji, past chairman CA Surendra Somani ji, and the Dhankober of the Ajmer branch, and CA CP Jain ji, our honorable past chairman of Ajmer branch, and very, very wise chairman of Ajmer branch, CA Arihant Jain ji, and a very dynamic secretary of the Ajmer branch, Ansul Heda ji, honorable CA Divya Somani ma'am, very, very active member of the managing committee of Ajmer branch, and we are really fortunate enough that we are having the presence of our SICASA chairman, CA Rahul Jain ji, and the students, the future chartered accountants are very, very important for our profession. And all the members of the Ajmer branch, all the members from Rajasthan, from Central region, and from each and every part of the country and outside country present in this very, very important virtual CPE meeting on role of securitization and covered bonds in a deepening fixed income market of India. And as rightly said that our both the resource persons, Ajinkya ji and Ansul ji, are IITians and are really doing wonders in the capital market. So the chartered accountants, who are the best accounting professionals across the globe, can really do something great in the field of capital market, as chartered accountants do deal in figures day in, day out, whether they were a student at that time also and after they become the member of the Institute of Chartered Accountants of India. So chartered accountants are best suited professionals to really do something concrete in the field of the capital market. So very, very good afternoon to all of you, and hearty welcome on behalf of the Institute of Chartered Accountants of India and the Committee on Capital Markets and Investors Protection. Friends, ICAI has always worked at providing requisite training and equipping its members with the necessary skills and knowledge required to spearhead our country towards economic prosperity. When we do talk of the 5 trillion economy, dream of our Prime Minister Modi, I think when our capital market will be strong, then only I think this target can be achieved, and the role of the members of the Institute of Chartered Accountants of India will be very, very important in this endeavor of the Prime Minister Modi. And the committee has come up with this virtual CP meeting on the role of securitization and covered bonds in deepening fixed income market of India. Friends, the Committee on Capital Market and Investors Protection, popularly known as CCMIP, has been entrusted with various responsibilities like providing suggestions on various bills, regulations, notifications, suggestions on the circulars, and other documents relating to capital market for submission to the government, regulators, initiating research studies in the field of capital market and investors protection, conducting training programs for members and others on matters relating to capital and commodity markets. So we are trying our level best to see that how we can really protect the interest of the investors also, and how we can try something very, very concrete for the investors' awareness and investors' protection. The Committee on Capital Market and Investor Protection works in the area of promoting investors' protection by nurturing capacity and competency development, not only of members and stakeholders in the capital market, but also the investors. The committee will be actively working in the area of financial literacy for the development of economy through various initiatives to educate and empower citizens at large. The committee also works to develop competitive workforce for capital market and corporate through its various learning initiatives like workshop and training programs on capital market. It conducts 2 flagship certificate courses for professional development of members in the field of forex and treasury management and derivatives. Very, very important certificate course, not only for the profession but also for the nation. In fact, one of the very, very important decision which Dr. Amit Agrawalji was mentioning has been taken by the Committee on Capital Markets and Investors Protection, the very first meeting of our CCMIP, to allow our honorable chartered accountants to trade in derivatives in individual capacity, besides being in whole-time practice. Whether one is a practice as a proprietor or a partner, can now very well have the income from trading in derivatives in individual capacity. So this is very, very important decision that shows the importance of the chartered accountants in the field of the capital market. Friends, in the past few years, the domestic corporate bond market had seen increasing volumes, largely due to financial investments going into it, including retail participation. And India is emphasizing the deepening of corporate bond market for various sectors, as well as monetizing and securitizing the assets to provide greater role for the foreign portfolio investors. Rightly said, a corporate bond market might be what the doctor ordered, but it still seems some distance away. For the Indian economy to revive and kickstart again post COVID-19 scenario, our debt market have to scale up. As a nation, we cannot afford economic stagnation, for which a robust debt market is essential, in which the covered bonds and securitization have a very, very important role to play. Talking about securitization, it is a process through which liquid assets are transferred into a more liquid form of assets and distributed to a broad range of investors through capital markets. The first widely reported securitization deal in India dates back to 1990, when Citibank securitized auto loans and placed a paper with GIC mutual fund. Since then, a variety of deals have been undertaken. From the point of view of the financial system as a whole, securitization increases the number of debt instruments in the market and provides additional liquidity in the market. It also facilitates unbundling, better allocation, and management of project risks. It could widen the market by attracting new players on account of superior quality assets being available. A former Reserve Bank of India Governor, Sri Sakti Kant Das, was once mentioned that promotion of the corporate bond market and securitization should continue to receive priority to enhance market-based solutions to the problem of stressed assets and appropriate pricing and collection of user charges. So here in today's VCM, we will be discussing about the role that securitization and covered bonds play in deepening the fixed income market of India. And friends, we are trying to have more and more webinars, more and more virtual CP meetings. In this time of crisis, in this second phase of Corona, I think each and every chartered accountant is very disturbed, and they are supposed to be at home. We are requesting each and every member of the Institute of Chartered Accountants of India to stay safe, to stay at home, to take care of themselves and to take care of their family members, and to keep them away from the negative thoughts, to keep them away from negative news which are there through in the news channels and in the social media. We are trying our level best to keep engaged our members of the Institute of Chartered Accountants of India in the productive activities, in the knowledge enriching activities, and we are trying to see that how they can sharpen their skills further. And keeping that thing in mind, we are trying to have the best of the resource persons day in, day out, so that our members of the Institute of Chartered Accountants of India can keep themselves engaged in the knowledge enriching activities and can be away from the negative thoughts and negative news which are there everywhere. And in turn, they can be very, very productive, not only for the profession, but also for the nation. So with this, I take the pleasure in welcoming the dynamic speakers of the day, Mr. Ajinkya Kulkarni and Mr. Anshul Gupta, co-founders Vint Wealth, who will fine-tune the concept and throw the light on the role of securitization and covered bonds in deepening fixed income market of India. I welcome all our honorable delegates present here from each and every part of the world to this very, very important webinar being hosted by Ajmer branch, very, very active branch of the central region, very, very active branch of Rajasthan. And I welcome all our honorable members from Ajmer, from Rajasthan, from central region, and from each and every part of the country and outside country to this very, very important webinar on the topic role of securitization and covered bonds in deepening the fixed income market of India. Thank you very much. Over to Dr. Amit Agarwal.
Thank you, Chairman Sir, for your opening remark. In your opening remark itself, you have given us insight, and it has now become very easy for us to understand this very, very technical topic. The way you have described in few minutes, so it is giving us the insight how is this session is going to be deliberated. Really, kudos to you, sir, for your this opening remarks. And not taking much time, I request Mr. Anshul Gupta ji, co-founder of Vint Wealth, for his deliberation. Over to Anshul Gupta.
Thank you, Amit sir. Thank you, Anuj sir. My screen is visible, right?
Yeah, it's fine.
Yes, yes, yes.
Great. Good afternoon, everyone. It's really grateful that Ajinkya and I have been invited to address this esteemed gathering. We at Vint Wealth have been trying to democratize the fixed income market of India, and securitization and covered bonds are two products that we have prioritizing, because we think both these products will play a pivotal role in deepening and democratizing the fixed income market of India. As a background, like Anuj sir mentioned, securitization product in India has been there for almost 3 decades now, and the market is growing at a very fast pace. Covered bond is a relatively new product for India. The first covered bond transaction took place in January of 2019, where a Rajasthan-based vehicle financing NBFC issued a AA rated covered bond, which was subscribed to by a large mutual fund. So let's delve into the presentation and try to understand what both of these products are and what are the advantages of these products and how they can ultimately help in democratizing the fixed income market of India. Right. So if I were to ask anyone, what's the common thing linking these 3 NBFCs? I guess the most common answer that anyone will receive is all these 3 NBFCs have defaulted on their on-balance sheet debt, which means they have defaulted on their bank borrowings, on their commercial papers, on their NCDs, etc. But very interestingly, there is one more feature which is common to these 3 entities. All 3 of them were very active participants in securitization market. Almost, Sri, for example, used to do at least 5 to 10 securitization transactions on a yearly basis. And DHFL and Reliance also was pretty active in this market. Interestingly, while these 3 entities have defaulted on their on-balance sheet liabilities, the securitization papers have been performing well, which means the investors who invested in their pass-through certificates or securitization transactions, they are receiving their money back on a monthly basis, while bond investors and banks which are given on-balance sheet debt to them are hardly getting back even a single rupee. And in a few securitization transactions, this repayment is almost 100% of the expected amount. So just notice the contrast. On-balance sheet lenders are not getting even a single rupee back, while in many securitization transactions where these three entities were the originators, investors are getting most of their money or most of their repayments. So that's the beauty of a securitization product. In future incoming slides, we will understand more about the market and the product. So the securitization market, it's now almost a 2 lakh crore market. It has grown at a very rapid pace over the past decade or so. Over the past 5 years itself, it has become 5 times in absolute size. More than 100 NBFCs have been participating in this market. The spectrum of these participating NBFCs is pretty wide. We have seen NBFCs with balance sheet as small as 20 crore also access this market. That's one end of the spectrum. And on the other side, we have seen NBFCs with a balance sheet as large as 1 lakh crore frequently tap this market. So this market, this also shows the maturity of the market. It is able to now cater to a wide spectrum of originators. In terms of investors, we are seeing mutual funds, large and small private sector banks, public sector banks, insurance companies, large NBFCs, ultra HNIs, and family offices, and even foreign investors now coming as investors in these structures. In terms of asset classes, the market is predominantly dominated by housing finance asset class, vehicle finance asset class, and microfinance. But of late, we are seeing various innovative asset classes like consumer durable, education loan, invoice financing, etc. These new asset classes are also coming in the market. So what basically is a securitization? Let's take a hypothetical example. Let's say there is a NBFC called as Bajaj Fin, which hypothetically has a equity base of 1,000 crore and has a existing debt of 4,000 crore, which means it has 5,000 crores worth of liability split as 1,000 crore of equity and 4,000 crores of debt. Let's say this capital has been already deployed by Bajaj Fin to generate a loan portfolio of 5,000 crore. Now, Bajaj Fin wants to further increase by this portfolio by 1,000 crore. But let's say Bajaj Fin neither wants to dilute its equity by issuing new shares, nor does it want to take on incremental leverage since it already has a leverage of 4x. So what Bajaj Fin does is it takes 1,000 crore worth of existing loans from its 5,000 crore worth of portfolio, goes in the market, finds a willing buyer, and sells this pool of loans to the investor. So this sale of existing loans to the investor, or this monetization of financial assets which are there on its balance sheet, conceptually is called as securitization. So that's more like a basic and conceptual understanding. Legally and in a practical world, how it's done is the sale is normally done to a special purpose vehicle, which is established as a trust. So SPV in the form of trust is set up, to which this portfolio is assigned or sold. This SPV is set up only to facilitate this sale of portfolio. And since it's a new entity which has been set up, it doesn't have any existing cash to finance this purchase. But since NBFC is selling its assets to a SPV, it would expect cash in return. This SPV finances this purchase by issuing certificates or securities called as pass-through certificates. Any investor in these pass-through certificates essentially gets a ownership of the trust, or in technical terms, what we can call is it gets a beneficial interest in the trust property. Any investor like a mutual fund, bank, foreign investor, HNIs, family offices, or even retail investors can subscribe to these pass-through certificates. The cash which is raised by the SPV by issuing these securities is paid to the NBFC as a purchase consideration for the portfolio which is being assigned. So in a nutshell, NBFC assigns the portfolio to the SPV. SPV issues these securities to various investors. The cash that comes from the investors is passed to the NBFC as purchase consideration for this sale of portfolio. The securities that are issued by the SPV or pass-through certificates, they are rated by a rating agency. These are CB accredited rating agencies. I think we might have heard of ICRA, CRISIL, CARE, India Rating, Brickworks, Informatics, SMERA, etc. So one of these agencies will assign a rating to the pass-through certificates. This will denote how much risk is there for the investor in these securities. It's primarily a function of two things. One is the credit quality of the underlying portfolio, which is being assigned to the SPV. And secondly, the rating agencies also stipulate something called as credit enhancement, which essentially is something like a cash collateral, which needs to be placed with the SPV along with the pool which is getting assigned. This cash collateral or credit enhancement serves as cushion for any losses that can come from the underlying portfolio. So let's say the portfolio that was getting securitized was worth 100 crores and rating agency stipulates a 15% credit enhancement. So this means the NBFC will park 15 crore worth of cash collateral with the SPV. And in case there are any losses that come from the underlying portfolio, till the extent of 15 crore, the cash collateral will absorb those losses. In case the losses cross this threshold of credit enhancement, that's the risk that an investor is taking. The cash collateral stipulated is primarily a function of the rating that we want to achieve for these securitization transactions. Obviously, higher the rating, higher would be the cash collateral requirement. And since higher rating would mean a lower level of risk for the investor, the yield or coupon or the rate of interest on the PTC will also go down. These securities can also be listed on BSE or other stock exchanges. However, since the market practice is not to list these securities, since these are predominantly bi-party transactions and there is hardly any liquidity. Further, a trustee is also appointed to monitor the operations of the SPV and to take care of the compliance of the SPV. The NBFC is appointed as the servicer because the portfolio that is being assigned, it's essentially a future payments due from a pool of borrowers of the NBFC. So someone needs to reach out to the borrowers and do the collection. Now, since trustee cannot do all these things, trustee normally appoints NBFC as the servicer, which means NBFC will reach out to the ultimate end borrowers, do the collections, and on a monthly basis, pass on the collections to the trustee. And these collections would be utilized by the trustee to make repayments to the PTC investors. So that's probably how the securitization structure works. I'll show a diagrammatic representation also. So just to repeat, in the diagram, you can see there is a NBFC, which is selling the portfolio to a SPV. SPV is a trust. Legally, it can be a company as well, but since managing a trust is easier from a compliance and operations perspective, market practice is to have the SPV in the form of a trust only. The SPV is issuing PTCs to banks, mutual funds, retail investors, etc. The money which is being raised is paid back to NBFC, more like a purchase consideration for the assignment of the portfolio. The rating agency is giving rating to the PTCs. Trustee is appointed to manage the operations of the trust. NBFC on a monthly basis does the collections from the end borrowers and transfers the collections that are coming from the pool to the trustee. From these collections, trustee will make the repayments to the PTC investors. Yeah. Let's also now understand, since we now have a decent understanding of how securitization work, why would a NBFC do a securitization and not just take a bank loan or issue an NCD to an investor? So first reason is quite obvious, which we discussed in our earlier slide as well. Let's say there is a NBFC with such a scenario wherein it is seeing incremental disbursement in business, but neither wants to raise equity, which means doesn't want to dilute its equity shares, nor does it want to take additional leverage. So in such a scenario, NBFC will resort to asset monetization via securitization. The cash raised can then be used to disburse or originate incremental portfolio. So that's like the obvious advantage. Another benefit under securitization is the rating of the securitization paper is kind of independent with the NBFC rating to a certain extent, which means it's quite possible the securitization paper will have a rating which is much higher than NBFC's standalone rating. This is happening primarily again because of two factors. One is the portfolio quality normally in such transactions happens to be much superior compared to the average portfolio that NBFC has on its balance sheet. Which means if it's a 1,000 crore NBFC and they want to do a 100 crore securitization, they'll cherry pick only good quality assets from its balance sheet and then assign the same to the SPV. Secondly, over and above this, rating agencies are also stipulating a credit enhancement. Because the portfolio is of very high quality and again backed by credit enhancement, the rating agencies might give a rating which can be 4 to 5 notches above entity's standalone rating. This means a triple B category NBFC can potentially issue a double A category paper, securitization paper, or a category NBFC can potentially issue even a triple A rated securitization paper. What this does is it opens doors to a very diversified source of investor capital pool. For example, if we talk about this triple B rating category NBFC, on a standalone basis, they may not be able to borrow money from mutual funds, because mutual funds, for example, tend to invest in only high-rated papers. For most of the funds out there, the rating thresholds are at least double A. They need double A category papers. So this triple B category NBFC can structure a double A category securitization paper and effectively raise capital, raise money from this mutual fund. Similarly, various other investors in the market have their own rating thresholds. Insurance companies, for example, rarely go below AAA rating in securitization transactions. Foreign investors, few foreign funds may have their own rating thresholds as per the internal policy, and so on. So, in a nutshell, yeah, securitization structure allows the flexibility to issue papers which are rated much higher than entities' standalone rating. A third advantage is something which is very peculiar to Indian market is priority sector lending benefits. Now, we would be aware that banks in India, they have their priority sector targets, which means if a bank has a balance sheet of 1 lakh crore, a certain portion of it needs to be dedicated and allocated to finance weaker segments of society, financially excluded sections of society, and so on. And these targets banks need to meet on a frequent basis, almost on a quarterly basis. But meeting these targets is a very uphill task for any bank. In many cases, they fall short of meeting these targets, for which there are severe penalties, etc. What RBI, Reserve Bank of India, has done is they have given banks this flexibility that banks can invest in securitization structures which are backed by priority sector assets, and this exposure can be counted under PSL targets. This means, let's say a bank is investing in a PTC transaction, which is backed by microfinance pool. Whatever money the bank has invested can be counted in PSL target. So this gives banks a very easy and convenient tool or a way to meet their PSL targets. So that's why you will see banks are very active in this market, especially in the PSL market. And normally during each quarter end, all the banks are running after whatever PSL pools are there in the market. The benefit to NBFCs is if they have a PSL pool of assets on their balance sheet, they can showcase the same to various banks, and banks can buy these pools at very fine pricing. The pricing at times can be very absurd as well. Recently, we saw a PSL pool which got financed at rates which was even below GSEC rates at that time. So imagine such can be the demand amongst banks for these PSL securitization transactions. Now coming to the motivations why a investor will want to invest in securitization versus bond of a particular NBFC. So if you look at the recent defaults that have taken place in the NBFC sector, you notice that two factors are contributing a lot towards these defaults. One is the corporate governance risk or fraud risk, and second is something what we call as asset liability mismatch risk. So a lot of recent defaults that have taken place have been primarily driven by one of these two factors. And we'll see that how securitization tries to mitigate both these risks for the investors. So let's understand how corporate governance risk is mitigated. So when you invest in a bond of any NBFC, a regular bond, you need to understand that you are taking a call on a dynamic underlying entity, because the money that NBFC is raising by issuing the bond will be further utilized to originate new assets. These assets can be in newer geographies, newer products, which may not be tested and hence might be riskier. In the worst case scenario, can also be used to finance related party entities of the NBFC. Further, the monitoring of end use of funds is very difficult in a regular bond. You just give money to the NBFC and put some covenants that, okay, you cannot do ABC things, but apart from that, anything else you can do. But if you compare this to a securitization transaction, the SPV, it's a static pool. Once the assets have been purchased by the SPV, there is no incremental lending which is possible. The only transaction that the SPV is doing is getting collections from the underlying pool and paying the same to the investors. Apart from doing this simple transaction, SPV is not allowed to do anything else. Because the structure is static, there is no incremental lending, and this is the only transaction which is possible. The risk of fraud gets mitigated and eliminated to a large extent, provided the underlying pool has been thoroughly audited. Further, the monitoring of this structure is done by a trustee. So even the corporate structure is very clean. There is no related party to the SPV, no management, no board. Just a trustee is monitoring this flow of cash from the underlying pool to the investors. So this simplicity significantly reduces the fraud risk or corporate governance risk for the investors. Second is asset liability mismatch risk. Again, if let's take an example. Let's say you invest in the NCD of a housing finance company. Let's say the tenor of the assets is 10 years. And let's say you invest in a bond, which again has a tenor of 10 years. Now, at the point of this investment, the tenor of the assets completely matches with the tenor of the liabilities. So there is no mismatch. But again, NBFC is a dynamic entity. This is not the only liability which this NBFC will be taking. Tomorrow, if an NBFC thinks the rates in commercial paper market are pretty low, they might even issue a 1-year commercial paper with the hope that at the time of maturity of the commercial paper, they'll be either able to roll it over or refinance it by raising some other liability. Because cash flows from the asset will come over a period of 10 years, but the payments for this 1-year CP is due within 1 year. So NBFC needs to either roll it over or refinance it. And this introduces ALM risk for the NBFC, because tomorrow there is no guarantee that someone will refinance this commercial paper. Such a ALM mismatch is not possible in a securitization structure, because there is just one pool of identified assets which are there on the asset section, and there is just one liability, which are the PTCs which have been issued. Once this issuance is done, SPV cannot raise any other liability. And the terms of these PTCs are so defined that they mirror the repayments of the underlying pool of assets. So there is no question of having an asset liability mismatch in a securitization transaction. So yeah, so both these risks which have been contributing a lot towards recent NBFC defaults have been vastly mitigated by the securitization structure. Other benefits, like we mentioned in the earlier slide, are PSL benefits that a bank can get by investing in a PSL pool, priority sector lending backed pool. And obviously, investors can get a much higher rating on their securitization exposures, which for a bank can reduce the risk weight it needs to allocate for that exposure. For example, let's say a triple B entity is issuing a double A category securitization paper. If a bank were to lend a term loan to that triple B rated entity, the risk weight will be much higher. Vis-a-vis if a bank were to take exposure on the double A rated pool originated by the same NBFC, the risk weights will be much lower. So the ROE for the bank will be much higher in the securitization transaction. Let's also understand some of the risks which are there in the structure. It's definitely not a risk-free structure still, even though a lot of risks have been mitigated. So first is the credit risk. Like we discussed in the earlier structure slide, essentially the investors are taking a call on the underlying pool of assets. There is some level of credit enhancement which has been stipulated by the rating agency. But tomorrow, if the losses in the underlying pool of assets were to exceed the enhancement which is there will be some shortfall to the investors. Hence, while taking exposure in any such a structure, the cherry picking of the underlying loans becomes extremely important. Second risk which is there in the structure is something called as servicer risk. Like we saw in the earlier slide, the trustee by itself cannot do the collections from the end borrowers. So NBFC is appointed as the servicer of the SPV, and NBFC goes to the end borrowers, takes the repayments, and passes the same to the trustee. Now, tomorrow, if the NBFC were to default, it may not be able to completely deliver on this service. There might be attrition in the team, some branches of NBFC might close down. NBFC might wind the operations altogether also. Legally, trustee has a right to appoint an alternate servicer in that case. But this transition from NBFC to an alternate servicer may be slightly operationally difficult to manage. Though we have seen instances in recent past wherein such a transition has taken place, but in a few specialized pool of assets, such a transition may be slightly challenging. So to that extent, there is some counterparty risk on the NBFC still. Third is the liquidity risk. These are bespoke structures. So the liquidity for these instruments is limited. If one is investing in such structures, one should invest with the mindset to hold till maturity, because there may not be a willing buyer in the market if one wants to exceed before the scheduled maturity. And lastly is the prepayment risk. Again, like we discussed in the earlier slide, whatever collections come from the underlying pool of assets are passed to the investors. Let's say there was a 100 crore commercial vehicle backed pool of assets, from which 1 crore principal repayment was expected in month 1. Now the investor was budgeting a repayment of 1 crore. But let's say a few customers in the underlying pool ended up pre-closing their term loans worth 20 lakhs. So the actual collections in the underlying pool is now not 1 crore, but 1 crore of scheduled redemption plus 20 lakhs of prepayments. So this entire 1.2 crore will be passed to the investor. So investor has received 20 lakh principal extra compared to what he or her was budgeting. And this investor would need to redeploy, which introduces a reinvestment risk. So the broad point is the cash flows in a securitization structure can be slightly volatile compared to the expected cash flows. Right. So at Wintwealth, we introduced securitization as one of our first products, and this prepayment was something which was like really pinching our investors. We used to get a constant feedback that they would rather prefer a steady stream of cash flows. So, as a solution to some of the issues that were coming in securitization structures, we launched something which is called as covered bonds. So, covered bonds, it's a relatively new product in the market. The first covered bond, like I mentioned earlier, was structured in January 2019, in which a Rajasthan-based vehicle financing NBFC, a triple B category vehicle financing NBFC, issued a AA rated covered bond, which was subscribed to by a mutual fund. Structurally, a covered bond offers two additional advantages compared to securitization structure. One is the stream of cash flows in a covered bond are fixed. The investor knows on what date how much cash flows are to be expected. Secondly, while in securitization, investors only have recourse to a bankruptcy removed pool of assets. In a covered bond, investors have a dual recourse, which means NBFC is liable to pay the bond. In case if NBFC defaults, there is a bankruptcy removed pool of assets which can step in to repay the covered bond investors. Let's see how the structure works. So this is a diagrammatic representation of a covered bond. If you see, the structure is somewhat similar to a securitization structure in the sense that here also a special purpose vehicle is created. The pool of assets is assigned to the SPV. Simultaneously, NBFC issues a NCD to which the investor will invest in. So investor essentially is investing in NBFC's NCDs. The obvious question will be then, how is the investor getting recourse to a separate pool of assets? This happens via a guarantee that SPV gives to the NCDs. So essentially, NBFC issues a NCD to which investor subscribes to. In parallel, NBFC sets up a SPV to which the pool of assets are assigned or sold. SPV guarantees the NCD obligations of the NBFCs. In case NBFC is performing, they will make the repayment. In a scenario that NBFC has defaulted, become bankrupt, etc., the covered bond investors can invoke SPV's guarantee. And once that guarantee is invoked, the structure becomes like a securitization structure. The collections coming from the underlying pool of assets will be utilized to pay the NCD investors. Since now NCD investors have invoked SPV guarantee, all the rights over SPV's property now belong to the NCD investors. And SPV property is nothing but a pool of assets which have been assigned only for the benefit of NCD investors. Obvious question here is, how is this bond different from a regular bond? I mean, even in a regular bond, the bonds are backed by pool of assets. For example, Diwan Housing had issued regular secured bonds, which were backed by pool of retail mortgages, which Diwan Housing had given to its end borrowers. A key difference is, in a regular bond, the pool of assets remain on the balance sheet of the issuer. While in case of covered bond, they are transferred to a special purpose vehicle, a third party, which then guarantees the NCDs. Since the legal ownership of the underlying security pool is being transferred to a third party, this pool of assets become bankruptcy remote, which is not the case in regular secured bonds, because in regular secured bonds, the ownership of the security pool remains with the issuer. So if tomorrow issuer were to default and go bankrupt, even the pool of security covered will become a part of bankruptcy proceedings. So that way, in a regular secured bond, the underlying security is not bankruptcy remote, while in a covered bond, since this assignment has happened to a SPV, the underlying security pool becomes bankruptcy remote. These covered bonds can also be done in loan format, which means you can have a covered loan as well. Bonds can be MLDs also, which means payout under the bond can be linked to a market reference index. So we can have covered MLDs also, which is becoming a fairly popular product over the past year or so. So that way, covered bonds, I would say, are a superior structure to securitization, because you are getting dual recourse. Not only do you have a bankruptcy remote pool of assets, you also have recourse to the NBFC. And secondly, the schedule of cash flows are fixed. You have visibility on this date. This much amount of repayments will come from my investment. A quick recap between the three major fixed income products now that we have in the market. These are covered bonds, securitization, and normal bonds. If one were to talk about the instrument which is there as the underlying for each of these three products, covered bond, obviously the underlying is a NCD. I mean, if you look at this example, you are effectively investing in the NCD. The pool is secondary. The pool, the benefit of pool comes via guarantee. But the instrument that you are investing in, it's still a NCD. In case of securitization, like we saw in the earlier slide, the underlying are something called as pass-through certificates. These are securities which the trust has issued. In case of normal bonds, obviously the underlying would be NCDs. Second important characteristic is there a presence of a underlying pool which is bankruptcy remote, which means if the NBFC were to go bankrupt, is there a pool of assets over which I have full control, the repayments from which will come to me, and the pool will not become a part of bankruptcy proceedings. In covered bond, again, like we saw here, since the ownership of the pool is transferred to a SPV, this transfer makes the underlying pool bankruptcy remote. Tomorrow, if the NBFC were to go bankrupt, this pool of assets belongs to the covered bond investors. The repayments from this pool of assets will directly go to the covered bond investor. It will not get stuck in the bankruptcy proceedings of the NBFC. So that way, yes, covered bonds have an underlying pool which is bankruptcy remote. Same is the case with securitization. Again, in securitization, a special purpose vehicle is set up to which the portfolio is sold or assigned and hence made bankruptcy remote. We have seen many examples now in the recent past, like I discussed in my first slide also. In case of DHFL, Reliance Capital, Reliance Home Finance, or Shrey, the underlying pools of assets have in fact been bankruptcy remote. The money coming from those pools is going to the securitization investors. Interestingly, in case of Divan Housing, few investors, bond investors, did go to Bombay High Court and pleaded that securitization investors should not be getting their money back. But Bombay High Court also ruled in favor of the structure and mentioned that in case of securitization, the underlying pools will actually be bankruptcy removed and they should not be made part of the bankruptcy proceedings. Subsequently, even Government of India has released a legal framework under which it has been mentioned in very clear terms that any asset which has been securitized cannot be a part of a bankruptcy proceeding. And if NBFC is doing any collection from that pool of asset, that money belongs to the securitization investors, and that money should be passed on to them. In case of normal bonds, the underlying pool is definitely not a bankruptcy mode, since the ownership lies with the issuer. For example, in Diwan housing case, even though retail borrowers are paying their repayments on time, that money is stuck in the bankruptcy proceedings. It's not going to the bond investors. Third point is whether, along with the bankruptcy remote pool of assets, do we have recourse on NBFC? In covered bond, yes, there is a dual recourse. Firstly, on the NBFC, secondly on the underlying pool of assets. In case of securitization, the only recourse is on the underlying pool. Other than the announcement which NBFC has given, there is no recourse on the NBFC. In case of bonds, obviously, since you are investing in the bond of the NBFC, there is full recourse on that NBFC. Next point is there any prepayment risk for me if I invest in these products? In covered bonds, like I mentioned, the schedule is defined upfront, which means on this date, this much amount of money will go to the investor. So that means as long as NBFC hasn't defaulted, there is no prepayment risk for a covered bond investor. In case of securitization, yes, if there are prepayments happening from the underlying pool, those will be passed to the securitization investors. So the cash flows will be volatile. Again, in case of normal bonds, there is no prepayment risk. It works like a covered bond only. The schedule of dates and amounts is defined upfront. In terms of rating of these products, in covered bond, yes, the rating can be 3 to 5 notches higher than NBFC's standalone rating, because like we discussed, if NBFC doesn't pay, there is a pool of assets which can pay, provided the pool is of good quality. The rating of this entire structure can get enhanced by 3 to 5 notches. Same logic works for securitization as well. As long as the pool is of a credit quality, which is superior to NBFC's average balance sheet, and there is adequate cash collateral or credit enhancement, the rating can be 3 to 5 notches higher than NBFC's rating. In case of normal bonds, since there is no additional structural mitigant, the rating of normal bond is capped at NBFC's standalone rating. Yeah, so far these products, have been there in the market. A lot of mutual funds, banks, foreign investors, family offices, and other institutional investors have been very actively investing in these products. Securitization market, like we discussed, it's a 2 lakh crore annual market. But these products haven't been accessible to retail investors like you and me. Even HNIs, if they wanted to invest 5 lakh, 10 lakh, 15 lakh, 20 lakh, they did not have access to these high quality products, which are backed by bankruptcy remote pool of assets, asset backed in case of secured pools, etc. So that was a big problem for retail investors. And that's where I, Ajinkya, and couple of my co-founders thought we should democratize this fixed income market. And that was the idea behind setting up Vint Wealth. So via Vint Wealth, we are trying to democratize this market and make securitization, covered bonds, etc., accessible even for retail investors. So uh, any investor can now invest in these products. The ticket sizes are as small as 10,000 rupees. Wind Wealth per se is backed by uh, Zerodha's Rain Matter Fund. We raised equity from Zerodha Fund. Zerodha is now the largest broker in India. Additionally, Ganesh, who was the co-founder of Suryoday Small Finance Bank, he has also invested in his personal capacity. Other angel investors like Kunal Shah, Amit Chaudhary, who was the partner of Motilal, they have also invested. So yeah, Wind Wealth essentially is trying to democratize this market and make it available for retail investors, semi-HNIs, HNIs, and other mass affluent investors. Yes. So I'll open the floor for questions now.
Thank you, Anshulji, for your nice deliberation on a very, very technical topic. A really very wonderful presentation by your good self. And yeah, now house is open for open question answer. Before that, I would invite Anjika Kulkarni sir for his words of wisdom. He can if he would like to share any top of what you have already shared. If he would like to share anything.
Sure.
Meantime,
Yeah, thank you, Amit. I guess Anshul has given a brief background. So, what I want to.
Anshulji, you can exit from, you can stop screen sharing. Yeah, thank you.
So, what we are doing at Wind Wealth is basically democratizing this access. And we are basically trying to figure out why are these elements not accessible for retail investors and trying to solve the problems. And what we think is like there is no presence of retail investor in debt market, and that is bad for growth of country. I mean, in US the bond market is as big is 4 times bigger than the equity market, but in the retail investors are hardly present in fixed income market. To change that, we are making an effort, and so that means that you have to model those products which haven't been yet done. So if you look at any fixed income securities, they are generally traded. There is some YTM, yield to maturity. There is some coupon rate, and those things make it very complex for the investor. Saying say for a retail investor to comprehend and understand. When our interest rate changes, the yield of the bond decreases or increases. So if the repo rate increases, the bond yield decreases, the bond price decreases. And these are very complex mathematical formulas for retail investor to understand. So we are trying to simplify that for consumer by making the transactions only available, like secondary transaction at par. So if you have bought a bond at 11%, when you sell, you will get a pro rata 11% return. Right. So these small enablers for the consumers will make the market open for retail investors. And for long, banks have been what we have seen is that there are large profitable businesses, but which are not retail brands. Therefore, like retail brands like Mahindra, Tata, Bajaj. So they cannot go and raise retail money, and they only have access to loans from banks, and often those are very expensive. The interest rate is much higher for the risk that they carry. And on the other hand, there are retail investors who are seeking yield. So banks have been sitting on these spreads for too long. And it's high time that these businesses get capital at a reasonable rate, and retail investors also get a interest rate which is decent than FD. And that's what we have been working on. That's been a focus where we are trying to cut out the corners, making it more adaptable for the retail base, and also educating people about the assets, the risk involved, the benefits. And we have been having great response. Many CAs are helping us. We work with a lot of partners. Retail investors are also like fortunately people because of like last 1 year the digital adoption is so fast that people are ready to today invest, getting educated on online and then taking investment decision digitally. So those factors have been encouraging. It's pretty early to say, but we are very confident that we will make some inroads and make this fixed income market accessible for retail investors, benefiting retail investors, the businesses on the other side, and the country as a whole. I'm pretty excited about it.
Yeah, thank you, Mr. Kulkarni, for your insight about the subject. And we are hopeful that the viewers had gained a new knowledge on the subject in today's deliberation. So we have a lot of questions to deliberate. With the permission of the chairman, I would seek a few minutes from the chairman after this question answer center to share my views as a secretary on Capital Market Committee to disseminate the information about the certificate courses. After this question answer session, Chairman sir, should I open the house for question answer?
Yes.
Yeah. So over to Chairman sir.
So thank you, Ansulji. Thank you, Ajinkyaji, for the nice deliberation. We are having around 3,000 delegates listening very, very carefully about the developments in the capital market. Deepak Navani ji from New Delhi is having one query. Divya ji, you will ask the query?
Yeah, sure, I can ask that. Deepak Navani ji from New Delhi has asked, what interest or ownership would the NBFC really have in collections, especially when they have sold the portfolio to a SPV?
Sure. I'll take it.
Yes.
So in case of securitization, normally rating agencies stipulate a first loss credit enhancement, which normally is in the range of 15 to 20%. So which is NBFC's skin in the game. And as a background to this, after the 2008 US crisis, wherein entities were just originating to sell, RBI came out with a guidelines regulating this market. The crux of the guideline was there should be incentive alignment in the ecosystem, which means, firstly, NBFCs cannot originate loan and securitize the very next day. So they introduced a concept of minimum holding period or seasoning, which means the loans need to remain on the balance sheet of the NBFC for at least 3 to 6 months before they can be sold off. Second regulation was something called as a minimum retention ratio, which means in any transaction that the NBFC does, they need to have at least 10% exposure along with the investors. And this exposure is normally junior to other investors, which means any loss that comes from the underlying pool till the extent of first loss, that will be borne by the NBFC. So that way, NBFC's interests are completely aligned with the investors. Because in case there is any loss in the underlying pool, their first loss, their cash collateral will be at risk.
Yeah, thank you. Next question is from Mr. Taras Jain, CA Taras Jain ji, my good friend from Bhopal. He is asking, in balance sheet of NBFC, where this securitization fund will be displayed, in balance sheet of non-banking finance company, where this securitization fund will be displayed.
Right. So there are two answers to this. After this, before this Ind AS new accounting standards, these assets used to go off balance sheet, which means, let's say, NBFC securitized 100 crore worth of pool and gave only 10% FLDG. So that 10% will appear on the balance sheet. The balance 90 crore will go off balance sheet. And the cash which has come from the investors will come in its place. Under the new Ind AS guidelines, these guidelines state that if NBFCs are giving FLDG, which are under RBI regulations, they have to give, the pool, even though it has been sold off, will still get consolidated along with the other assets of the NBFC. So under the new guidelines, these pool of assets continue sitting on the balance sheet.
Yeah, thank you. Divyaji, next query, please.
Yes, sir. So we have participants from all over India. So it is just a great session. Firstly, I would like to congratulate both of you speakers, and the topic is so relevant during this time that everyone really wants to know the in-depth of this subject. Our next participant, Saloni Sadana, who's from Delhi, she has asked, how would investors ensure that servicing agent is collecting the dues properly, as NBFC has already transferred his risk?
Sure. I think it's kind of linked to the first question that was asked. NBFC's incentives are very much aligned with the investor's interest because there is a FLDG. Additionally, there is a recurring audit which is done to ensure that whatever collections which are coming from the underlying are actually going to the investors. So both these things ensure that there is no fraud happening at the servicer level. And in case such a fraud is spotted, obviously action can be taken against the servicer, and trustee has all the rights to switch the servicing to a third party.
So you said something about auditing. Can you please elaborate on that, please?
Yeah, so a third party auditor on a regular basis, can be quarterly or half yearly, does a sample audit of the underlying pool of loans which are assigned to the SPV. That they'll on a random basis check whether a customer has paid or not, and whether that information is reconciling with the information that servicer is sharing with the trustee.
So is it published somewhere, or some knowledge is given to the investors also?
Yeah, normally these reports are shared with the investors. Depends on the transaction to transaction.
Yeah.
Okay.
Thank you. Thank you, Anshulji. Next query is from R. Ravichandran ji from Gurugram. Now that we are into the COVID period, can the RBI not put across some guidelines for issuing a special securitization receipt which is linked to the COVID effect on the industry for MSME, and that may perhaps give the latter a more acute source of funds at reduced affordable rates? Should I repeat?
No, I think I got the question, Anuj sir. Yeah, I think a better way to deal with this is maybe offer a kind of guarantee, because then only you can get the commercial capital. If you just give a PSL benefit to, let's say, COVID affected pools of assets, I don't think banks will be incentivized to that extent. But let's say if government can give a guarantee on these structures that, okay, originator has given 15% FLDG, here is my 20% FLDG, which is over and above that. So that risk for the commercial investors gets reduced. That I think will be a much better motivation and will bring in more pools of capital. And they actually did this during the last lockdown. Government came out with this PCG scheme, under which our government was guaranteeing retail pools up to 10%. So maybe same can be extended now also. And one of the major issues in the last scheme was it was only available for public sector banks. Maybe the spectrum can be extended to private sector banks, mutual funds, etc. also, because they are a bigger participant in the securitization market compared to PSU banks.
Yeah, Divyaji.
Yes, sir. Sir, Saloni ji has again asked one more question from Delhi. Do we have any structure like us wherein agency guarantees the payment? So I think it's more about the guarantee part.
Okay, I think she's referring to the US structure. In
US structure. Okay.
In US, we do have these government agencies, Freddie Mac, Fannie Mae, etc., which give a guarantee on the mortgage pools. In India also, there is one guarantee scheme which is run by SIDBI, that is only applicable for SME pools. That is called as CGT SME scheme. So we have seen in the market a few pools, SME pools, which are backed by CGT SME guarantee. But the guarantee for those pools, it's partial in nature. Earlier, the threshold was 75%. Now it has been brought down to 50%. So yes, those semi-guaranteed pools of SME loans are there in the market. So far, nothing in housing space yet in India.
Yeah, Divyaji, next query, please.
Okay. So next question is from R. Ravi Chandran. He's from Gurugram. If it is possible to do fundraising using bonds similar to that of CAT bonds in insurance industry, I'm not sure this is possible. Please do advise. So should I repeat or you got the question? Let me just read it again, sir. If it is possible to do fundraising using bonds similar to that of CAT bonds in insurance industry, I'm not sure. Is this possible? Please do advise.
Yeah, under securitization, I don't think something like this can be done. So yeah.
Okay, so next question is from Ravi Prakash Gupta ji from Prayagraj. He's asking how the SPV has only liability of PTCs, then modus of operandi to repay PTCs amount as and when payable. Kindly elaborate.
Right. So the liability terms of this PTC, they are structured in two manner. One is something called as timely interest, timely principal PTC structure. Second is a timely interest, ultimate principal PTC structure. In the first case, where even the principal is timely, you have a schedule of cash flows, and that much amount needs to be paid every month by the SPV to the PTC investor. If that is not done, it amounts to an event of default for the SPV. In case of ultimate principal structure, there is a long stop date, which means, let's say, by the end of 3 years, all the principal has to be repaid to the investors. So both these types of liabilities are possible. But yes, the only liability which SPV can have are the PTCs. Over and above this, there cannot be any other liability. And the terms of this liability can be customized and structured as per the investor requirement. It can be due and payable every month, or it can have a long stop date by which it needs to be fully repaid.
Yeah. CA Ravi Prakash Gupta ji is very senior member of the profession from Prayagraj, Allahabad. Then we are having one query from Arun Kumar ji from Faridabad. Divya ji?
Yes, sir. Sir, he is asking, if once NBFC cherry-picked 1,000 loan from its portfolio and made a SPV, if NBFC after a certain time again wants to pick another 500 loans from its portfolio, whether it has to make another SPV or earlier SPV can be used? So a very good question, I think.
It can be done both ways, actually. Recently, RBI has come up with a revised set of regulations. Those are still draft in nature. But in those draft guidelines, they have introduced a new concept called as revolving securitization structures. In revolving structures, any rundown which happens can be replenished, which means, let's say the 100 crore pool of assets was securitized. And in month 1, 2 crore has run down. So NBFC can replenish that rundown amount by 2 crore worth of incremental loans. But that addition will be as per a predefined criteria. So it's only there in the draft guidelines. It hasn't been approved yet. But let's see once the final guidelines come. So once those updated guidelines come, the revolving structure, I think, will become very famous in India.
Yeah. Then we are having the query from Devesh Harikrishna Malviya from Mumbai. He's asking, what will be tax treatment for FPIS in case of covered bonds compared to investing in PTCs? We have covered it.
The taxation for NCDs, it's like completely different compared to taxation for PTCs, for foreign portfolio investors. In case of NCDs, it depends on the jurisdiction from where they're coming. but it ranges between 5 to 15%. In case of PTCs, there is a TDS of 25%, which is deducted at source as per the income tax law. But that TDS can be reclaimed back by the investors, depending on the double taxation avoidance agreement that their jurisdiction might have with India. So again, it depends on the jurisdiction from where they're coming.
Yeah. Then Saloni Sadana ji from Delhi is asking for the PPT to be shared. If our resource persons will allow, then we will share the PPTs with the participants.
Sure.
Yeah.
Yes,
Then
the next. Sumit Nalin Gadia ji is asking. He's from Kalyan. He's asking, in covered bond collection from pool of assets is passed on to SPV or kept with NBFC. What if value of pool of asset goes down due to collection?
Right. So in a covered bond, like sir correctly mentioned, normally the bond is repayable at maturity, but the underlying pool of assets would be amortizing in nature. So in covered bond, that replenishment of underlying security cover is done to ensure that security cover remains at initial value. Let's say the bond was 100 crore and the cover required was 1.2x. So on day zero, we have 120 crore worth of pool, but bond is repayable at maturity. So the bond outstanding will remain at 100 crores while the pool is running down. So whatever rundown happens in the underlying pool, NBFC replenishes it by assigning incremental pool of loans. In case NBFC doesn't do it, it becomes a trigger event and the structure starts amortizing.
So trustee has to take care of it, I guess.
Yes, on a monthly basis, incremental assignment is done by the NBFC towards the SPV.
Yeah, thank you. Then we are having one query from CA Ivan Eugen Rosario Mark from Mumbai. He is asking, in a covered bond investors finance the NBFC directly. So does the NBFCs receive any consideration from the SPV for the portfolio sold by the NBFC to the SPV?
Right. So there is a consideration, but it's only done for regulation purpose. Since a sale of portfolio is happening, NBFC should receive some cash. So SPV raises a loan from SPV, which is a subordinate loan, to finance this purchase. So it's essentially NBFC gives a loan to the SPV. That money is again comes back to the NBFC as purchase consideration for the pool that is assigned to the SPV. But that loan is junior to the covered bond investors.
Thank you.
So next question is from Aditya Umeshji from Thiruvananthapuram. In case of covered bonds, does the NBFC effectively act as an intermediary between the SPV and the investor that also absorbs the risk of securitization?
It doesn't act as an intermediary. I mean, the liability of NBFC in covered bond is definitely there. Whether the pool performs or not, NBFC still has to honor the covered bond instrument. So I don't think it's an intermediary. In case of securitization, one can call it only as a service provider. But in case of covered bond, the liability is definitely there. It's much more than an intermediary.
Yeah.
So next question is from Rishabh Gang from Indore. He's asking, please explain the cash flow structure under covered bonds for NBFC and SPV at the time of issue, during the life of SPV and final redemption. He's asking the whole accounting structure kind of thing.
All right. So on the settlement date, NBFC will issue a bond. Investor will invest in the bond. The money will go to the NBFC. Simultaneously, NBFC will give a subordinate loan to the SPV. The cash will be used to purchase a pool from the SPV from the NBFC to the SPV on a monthly basis. Whatever collections are coming from the underlying pool gets transferred to the trustee. As long as there is no trigger event and NBFC is replenishing the pool, the money will flow back to the NBFC only. On maturity, NBFC has to repay the bond from its own cash flows. Let's say NBFC has defaulted. from that month onwards, whatever collections are coming from the underlying pool, they'll start going to the investor.
Thank you. Yeah.
Yes, sir.
Yeah.
Yes, sir.
So thank you, Rishabh Gangji, for the nice question. Then we are having Dipali Vartak from Vasai. She's asking which regulator regulates the SPV, it being a trust.
Right. In case of securitization, there are regulations given by RBI. So the securitization trust has to be set up under the RBI regulations. Obviously, the normal trust law will be there. That also has to be followed. Over and above that, RBI's guidelines have to be followed.
Yeah. Then Mr. R. Ravichandran, he is asking from Gurugram. He is appreciating the deliberation of Ansulji. And then we are having the query from Satara, Mr. Mayur Pramod Devi ji. He is asking what is the advantage of securitization to the NBFC? How can it grow if it sells the portion of underlying pool?
Yeah, like I said, there are broadly three advantages. One is it can disburse new loans without diluting equity or taking additional leverage. Second is it can issue higher rated papers, so access cheaper cost of financing or a diversified pool of investors. And third is the PSL benefit, which is applicable only for PSL eligible pool of assets.
Yeah, thank you. Next question, please, Divya.
Yes, so we again have an appreciation from Deepika Suhaji. She's from Hubli. She's saying excellent presentation, sir. Next, we have a question from K. Madhavan from Chennai. He's asking, is it safe to invest in NCD issued by banking companies during this pandemic period? So very relevant question.
I think it's quite subjective as well. Depends on the NBFC. If the NBFC is fairly well capitalized, I think it's fairly safe. But one should avoid overly leveraged NBFCs, that too operating in unsecured sectors.
Yeah.
So next
then my
question.
very good friend Chandprakash Jainji from Jaipur, he is also appreciating the deliberation of our honorable guest speaker. And then we are having Devesh Harikrishna Malviya from Mumbai again. He is asking, can you clarify on the secondary market liquidity to covered bonds or bond PTCs in market? Would you consider liquidity as a major issue?
So yes, these are illiquid products. So if anyone is investing, one should invest with the mindset of holding till maturity. And as long as the tenor of the papers are less than 2 years, 3 years, I think liquidity is not that big a challenge because one can park some amount of liquidity for 1 year, 2 year, 3 year. But yes, for longer tenor papers, liquidity is definitely a bottleneck.
Thank you. Then Deepak Navaniji from Delhi is also asking for the PPT. So we'll coordinate with the resource persons and will send the PPTs. Then Neha Binawat from Ajmer itself. She's asking, sir, is rate of return is lower in covered bond as compared of other bonds?
Yes, to a certain extent, yes.
Any specific reason?
See, if there is no pricing benefit given to the NBFC, they'll issue a normal bond only. So some benefit needs to be given. Secondly, putting up this structure is also a costly affair. The security cover tends to be higher. There will be some amount of cash collateral also. Auditors need to be appointed, legal firms need to be appointed, trustees need to be appointed, rating agency needs to be appointed. So a lot more scrutiny happens, a lot more compliance is there. That again adds a 25 to 50 basis point in just putting up the structure.
Yeah. Then we are having one query from Badri and Subudhi from Bhubaneswar. What is legal status of Wind Wealth?
It's a normal company only. We have applied for a merchant banking license, but that's still awaited.
Yeah.
Okay, so next question is from Bharat Kumarji from Mithapur. He's asking for retail investors, what is the way to participate in covered bond markets indirectly?
I mean, As of now, only Wind Wealth is providing a platform for these products for retail investors. For ultra HNIs and family offices, they have various brokers which work with them. But for HNIs and mass affluent retail investors, Wind Wealth as of now is the only platform.
Okay.
Yeah.
So
Then
Suresh
Suresh Swamiji
Yes, sir,
from
please you
Mumbai
can go ahead.
is asking both Vint Wheels and Vint Gold on your website are fully subscribed. When will new investment opportunities arise?
We are getting a couple of assets by end of this month.
So he's so quick, he has seen your site as well simultaneously.
Yeah. Next query, Divyashi.
Next question is from Mayur Pramod Deviji again from Sitara. Will the investors in DHFL and NCDs get their money fully, or to what extent? What's the latest news in this regard? Market value of the NCDs in secondary market is down by nearly 65%. He wants your views on this, sir.
Slightly difficult to predict, but as per market expectations, there might be a haircut of around 40 to 50%.
Yeah. Then from Bhubaneswar, Badri and Subhuti again is asking, is Wind Wealth is subscriber to the SPV?
Wind Wealth, how our deal flow works is we invest in these transactions from our balance sheet. Then we sell it down to our investors in secondary market. So yes, we are the primary subscriber. Then subsequently we sell it down to our investors.
Yeah. Then Amit Himali ji. Yeah. Yeah.
I would like to interrupt in this. Sorry to disturb. Dear viewers, may I request you to not to ask some personalized question about the company, because it's an ICAI platform. You should avoid this kind of question.
Yeah. Then Mr. Amit Himali ji from Rajkot. This question is from Ajinkya ji. How can we join as a partner and promote this fixed income bearing product among retail investors clients?
That's a great question. Thank you for your interest. We on the website we have a form called Partner with Us. You can fill that form, and you should be able to. Our team will get in touch with you.
Yeah, I think these are the individual questions which can be responded by the resource persons on individual basis. So, Amit ji, we are having some more questions. Rupesh Jain ji, he is asking from Bhopal, my very good friend. Ajinkya ji thought it will take its time, but then with the markets for fixed income being available to retail. 1 second.
So should I take this up?
Yeah.
Actually, he's asking from Ajinkya ji. Thought it will take its time, but then with the markets for fixed income being available to retail investors, banks would have dropping NII in the coming times. In other words, the Indian banking industry, which is garnering a good spread now, with continue to go. So it's for you.
Could you elaborate on the question? I didn't get the question. So
okay, though it will take its time, but then with the markets for fixed income being available to the retail investors, banks would have dropping NII in the coming times. In other words, the Indian banking industry, which is garnering a good spread now, with continue to go. Does it? I think he's asking about the banking structure with the.
Yeah, he's saying because of players like Wind Wealth will bank spread decrease. Yeah. I can't really predict about it, but what I definitely believe is there are good opportunities for retail investors with cash. How banks will react is yet to be seen, because that is function of so many factors like what are repo rates and But this wholesale lending, yes, banks have been sitting on large pool of profits, and large chunk of that should flow back to retail investors. And that's what we are doing. Not sure how banks will react to it and how banks will readjust to it.
Okay. So
then we are having Deepali Vartak from Vasai. What is the benchmark rate for NCDs issued under covered bonds and PTCs? We have covered this.
So
What is the
benchmark rate they have
benchmark
not
rate?
covered.
What is the benchmark rate for NCDs issued under covered bonds and PTCs?
It kind of varies over time, but as on date, AAA rated covered bond or PTC will be between 8 to 9%. AA will be between 9 to 10%. A single A will be between 10 to 11%.
Yeah. Then Deepak Navani ji from New Delhi, please can you briefly differentiate between securitization as explained by you versus commercial paper? Securitization versus commercial paper.
Right. So commercial paper is just a borrowing of the NBFC. By definition, it has to be unsecured in nature and short tenor in nature. Securitization is a exposure on a portion of entity's balance sheet, which means it's sold to a SPV and you only have recourse to that identified pool of assets. In a commercial paper, the exposure is to the entire NBFC, but it is unsecured in nature by regulation.
Yeah, then we are having a query from Saurabh Modi ji, my good friend from Jodhpur. How do we think the role of IP would be as BLRC report focuses on depending fixed income market in India?
This income tax.
Should I repeat?
Yes, sir.
No. How do we think the role of insolvency professional would be as BLRC report focuses on depending fixed income market in India? On deepening fixed market income market in India. So I think we'll answer separately. It is basically related to the insolvency professional and may not be very relevant to the experts of the capital market. So I think we can get it answered separately. Dr. Amit Akbalji, you can take care.
Yeah.
Then from Abu Dhabi, we are having the presence of chartered accountants from each and every part of the world. And Arunachalam from Abu Dhabi is asking whether resources on NBFCs is available only in case of covered bond or whether securitization can also be done with the resource to NBFC.
I don't follow the question, sir, actually.
Whether resources on NBFC is available only in case of covered bond or whether securitization can also be done with the resource to NBFC.
I think he means recourse to NBFC. So in securitization, recourse is not possible. Only the FLDG that NBFC has given, which by regulation is capped to 20%. Only maximum of 20% is the recourse that under securitization one can have on the NBFC.
So next question is from Hitendra Raka from Ahmedabad. Pool of loans pertains to retail or corporate? Because in my view, if pool pertains to retail and home loans, it could be more secured for investors.
Right. We kind of agree with you. Mostly the transactions are backed by retail pools. And even within retail, I think from a risk point of view, commercial vehicle pools, mortgage pools, lab pools, gold pools are much safer compared to unsecured pools.
Yeah.
Then, so he's asking one more question. Is there anything like deposit-linked insurance for investors like we have for bank deposits from government?
No.
Then Suresh Swamiji from Mumbai, he's asking, if an FPI subscribes to the PTC, how will the upside income be taxed in the hands of FPI? Will it be the capital gains or income in respect of securities?
It will be interest income only, not capital gains. There will be a 25% TDS applicable, but a refund or refund can be claimed as per the respective DTA agreement. From whichever jurisdiction the FPA is coming, as per the DTA agreement, refund can be claimed.
Thank you. So next question, Divyaji.
Next question is from Aparna Rajgopalji from Chennai. She's asking, what is the average return on income that can be expected by an investor in a securitization trust of a SPV? Also, does the investor know which NBFC has sold that pool of assets?
Yeah. Investor would know who is the NBFC. They'll have details of the underlying pool also. Returns, like I mentioned, a AAA paper will be between 8 to 9%, AA 9 to 10%, and a single A rated paper between 10 to 11%.
Yeah, next query, Dikaji.
Sir Dharwad Gurucharji from Bangalore, he's asking, sir, what are the RBI guidelines for NBFC going for securitization?
So RBI has released two set of guidelines, one way back in 2006, subsequently in 2012, they have revised the guidelines. It's there on the RBI website.
So our thank you. Our two participants, Rakesh Kumar Jayant ji and Sagar Jathalia ji from Kaipur and Pune are appreciating the session like anything. Then Mr. Munish from Pune is also appreciating the session and is asking for the PPT. So we will of course share the PPT. And then from Hyderabad, Mr. Reddy is also asking for the PPT. And then from Delhi, Naresh Kumar Bhamdi is also appreciating the session. Then Mr. Mukesh Goyal from Jaipur, my very good friend, is also appreciating the session. And then from Delhi, Mr. Abhinandan Bedi is asking that how we can view this webinar again. We will be hosting it on our YouTube also. Amit ji, you will respond? Dr. Amit?
Yes, sir. Yes, sir. We will host it on ICAI TV.
ICAI TV also. It would be there on ICAI TV as well as the YouTube channel also.
Yeah.
So we'll share the link, etc., and one can very well view. So we are really grateful to our honorable guest speakers, Anshul Gupta ji and Ajinkya ji, for very, very good deliberation and responding the queries of all our honorable delegates. And we are really grateful to all our honorable leaders of the profession from Ajmer for their contribution for this virtual CP program. We are having the presence of our young and dynamic secretary of the Ajmer branch, CA Anshul Hiraji, and thank you Divya Samani ji for coordinating in this question answer session. So may I request the secretary of Ajmer branch, CA Anshul Hiraji, for the final words and vote of thanks, please. Over to Anshul Hiraji.
Thank you, sir. Good afternoon, everyone. So I, Anshul Heda, Secretary of Ajmer branch, take the opportunity to put my gratitude into words. On the behalf of Ajmer branch of CIRC, I would like to extend my heartiest thanks of our guest, Honorable Mr. Anuj Goyal sir, for his presence in webinar. Thank you, sir, for enlightening us with your inspiring and motivational words. You are an exemplary person. We have a lot of learn from you. Wholeheartedly, I must thank our session speaker, Honorable Mr. Anshul Gupta sir and Ajikya sir for his guidance and valuable deliberations. Thank you, sir, for assisting and encouraging all of us. I thank all the members for their presence in this webinar. Congratulations to organization team for our hard work, which made this webinar a memorable for one of all of us. Thank you. Have a good day. Thank you, sir.
Thank you, Anshul ji, and I'm really grateful to our office that in spite of this pandemic, Corona, all of them are having one or more problem and the Corona cases in their home. But in spite of that, whether it is Saturday or whether it is Sunday, whether it is late hours, they are working day and night to see that how we can really do something concrete for the cause of the profession and in turn for the cause of the nation. Dr. Amit Agrawal ji, our secretary of the committee, and we are having CA Rahul Jain ji, our Sikasa chairman, Ajmer branch is also there. And from office, our CA Rahul Palji is there, and our other chartered accountants are there who are working day and night for to see that how we can really do something concrete. for the cause of the profession. And I will reiterate once again. And Avnish Gargji, our honorable chairman of the Ajmer branch, I appreciate that in spite of this pandemic corona, they are trying their level best to keep engaged our members, our chartered accountants, and in addition to that, how we can really do something concrete for the society. Our chartered accountants, our branches are coming forward like anything to serve the mankind, to serve the affected individuals in the society. And each and every branch of our Institute of Chartered Accountants of India is trying its level best to do something concrete for the sufferers from this pandemic corona. And our committee, I will repeat again that we are trying our level best to see that how we can have more and more virtual programs in which we can have the best of the topics and best of the resource persons from each and every part of the world, so that our chartered accountants can keep themselves engaged in the knowledge enriching activities of the Institute of Chartered Accountants of India, our research committee, our committee on corporate laws and investors protection. I'm the vice chairman of corporate laws committee also. We are trying our level best to see that how we can really do something concrete, not only for the profession, but also for the nation by on organizing these virtual CP programs through our research committee. We are having research project scheme 2020. Then in this year, we have launched research project scheme 2021. Lot number of chartered accountants have taken this responsibility to do the research, which are very, very important for the profession and in turn for the nation. So I will request all our honorable viewers, we are having around 3,000 viewers from each and every part of the world, to see that how we can really do something very, very concrete in the research activities of the Institute of Chartered Accountants of India. We launched last year the ICAI research doctoral scheme, in which young chartered accountants up to the age of 40 years can take part in the PhD program. And for this PhD, we can reimburse up to 50,000 rupees per month to the eligible 5 candidates. So there is very, very tough competition among the researchers, young researchers. But we want to see that how our young researchers who can really contribute in the field of the research can come forward, and we will certainly identify them for this research scholarship, which will be there on the full-time basis. In addition to that, we are having 2 certificate courses, very, very important certificate courses of Committee on Capital Markets and Investors Protection. Dr. Amit Agarwal ji will like to say something about those certificate courses also. And last year, I was the chairman of the research committee last year also. We launched the first cross-border research award, ICAI International Research Award, which was, I think, the first in the accounting world. And in spite of pandemic corona, we launched it in a very, very successful manner last year. We got around 100 entries from more than 10 countries. And this time also, we are going to organize it in a good way. And we are trying to have it in the Dubai, where we are having very, very good presence in the Gulf countries of around 20,000 chartered accountants. So I will request all our honorable viewers to please see that how we can have more and more nominations for ICAI International Research Award, as well as ICAI Awards for Excellence in Financial Reporting. Our research committee was formed in 1955, and then in 1958 itself, that ICAI Awards for Excellence in Financial Reporting were introduced. So I will request all our honorable viewers to see that how we can have more and more entry for the ICAI Awards for Excellence in Financial Reporting, so that we can choose the best entity for that particular award. So I once again am indebted to a team Ajmer, led by our chairman CA Avnish Gargji. We are having the presence of Rahul Jainji, Sikasa chairman, and CA Avnish Hedaji, secretary Ajmer branch, and CA Divya Somaniji, past secretary Ajmer branch and past chairman of the Ajmer branch, and Dhankuber CA Surinder Somaniji. I am also viewing him. And may I request Dr. Amit Agarwal ji for in few minutes, if we can share about those certificate courses, which are very, very important for the chartered accountants. Over to Dr. Amit Agarwal.
Yeah, thank you, Chairman sir, for your motivating words and vision given by you in the committee. Let me share with you the viewers. We have two live certificate courses. One is on Forex and Treasury Management, another is on Derivative. And two of the certificate courses on Fundamental and Technical Analysis, including equity research, and one certificate course on Financial Management and Security Laws. So, we, through this Committee on Capital Market and Investors Protection, Chairman sir, you are kindly keep yourself on mute. Chairman sir. Yeah. So I would urge from this platform of this VCM to the viewers, because those who are connected in this VCM are more interested in the capital market, and we seek their well guidance. Please reach us at the ccmip@ici.in for your valuable suggestion how we can improve. What we will be through email, we will be reaching to you. We will share with you the course curriculum of these 4 certificate courses, and wherever you think that there is some addition is required, some outdated portion is there. So some continuous process should be going on to improve the quality of our certificate courses. So I would urge from this platform to all the viewers, please help us as a think tank of ICAI, and so that we can bring new things and relevant portion in these certificate courses. With these words, I thank all the hosting branch managing committee members, my own chairman, C. Anuj Goyal, and the speakers of the day, both the speakers of the day. Over to chairman.
So thank you, Dr. Amit Agarwal ji, and thank you our honorable guest speakers and all our honorable members of the managing committee of Ajmer branch, very, very active branch of our central region of Rajasthan. And we look forward to have more and more programs. And in this time of pandemic corona, I will request all of you to please stay at home. Please stay safe, and please take very, very good care of yourself and your family members. Together, we will win, and we will come out of this very, very tough phase. And the chartered accountants are known to convert the threat into opportunity. And I am quite confident that all of us will certainly see that how we can convert this great threat, not only to the profession, but also for the nation, and also for the mankind, into a opportunity for all of us. Thank you. Thank you. Have a very, very safe day. Thank you very much.
Thank you. Thank you, sir.
Thank you.
Thank you, everyone.
Thank you, everyone. Thank you.
Thank you, everyone.